Have you ever considered how the massive technological boom we are currently experiencing, the sheer fervor around artificial intelligence, could actually be the single largest structural risk to the stability of the world's largest economy?
It sounds completely backwards, doesn't it? We're sort of conditioned to think AI means, endless growth, pure upside.
Right.
But the analysis we've been digging into paints a much more sobering picture. Essentially, the American economy is standing on this one really high-stakes bet.
Which is?
The immediate world-dominating success of American AI tech. Nothing less.
So we're not talking prudent, gradual investment here. This is, well, the analysis calls it a geopolitical casino gamble.
Pretty much.
Okay, so our mission today is to really unpack this dependency. We need to look at the incredible cash burn involved, the extreme market concentration, which sounds, frankly, terrifying.
Yeah, the fragility it creates.
And those ominous historical parallels, the bubbles, all while looking at how the U.S. approach stacks up against China's, well, their counterplay.
It really is the highest risk, highest reward economic situation we've seen in, well, decades.
Okay, let's get into it. Why is the U.S. so committed? Why put all its chips on the AI table like this? What's the actual scale of this bet?
Well, the commitment seems born from a kind of perceived desperation, almost.
Desperation.
Yeah, because by many traditional metrics, the U.S. economy is lagging in key industrial areas. Think big shipping, EVs, core clean tech. China's made huge strides there.
Okay.
So AI gets framed as a golden ticket, the thing needed to paper over these widening structural cracks. It's seen as the only path left to maintain global economic dominance.
And the politics reflects that urgency. I mean, we've seen things like the National AI Action Plan.
Exactly. And while that sounds like standard government stuff, the goal behind it is pretty aggressive. It's about setting American AI standards globally explicitly to curb China's influence.
Sort of locking out the competition.
Before it can fully scale, yeah. But this ambition, it comes with a brutal price tag. The numbers being thrown around for infrastructure alone are just staggering.
Like what?
Well, one specific example, sometimes called Project Stargate, suggests $500 billion, that's $500 billion being poured just into AI infrastructure, data centers, fiber, power grids.
$500 billion, just for the plumbing.
Right, and that kind of spending has immediate systemic effects.
And Wall Street's buying it, obviously. AI is the narrative saving us from recession.
Yeah, that's the line. Some big analysts claim AI investment is adding maybe 1.5% to GDP right now. It's propping things up.
But it's not based on diversified output. It's based on this one thing.
And what's really fascinating, or maybe alarming, is how fast it's all centralized. That whole miracle, the 1.5% GDP boost, it pretty much hangs on one company.
Nvidia,
the king of AI chips, as they're called. Everyone, Meta, Google, Microsoft, they all need Nvidia's advanced hardware.
So if Nvidia hits a snag, a manufacturing delay, geopolitical issues,
the whole promised miracle just vanishes. Poof! That's incredible fragility built right into the core of the U.S. economic outlook.
That centralization is terrifying. And it sets up the next point perfectly. The sheer amount of cash demanded from everyone else. You mentioned 4 tech giants planning to spend $330 billion this year.
This year alone. And that's expected to jump towards $400 billion next year, just chasing the AI dream.
But is that spending sustainable from a normal financial perspective?
Not really, no. Look at the most prominent example, OpenAI. They're kind of the face of this AI future, right?
Sure.
They plan to invest something like $300 billion in computing power over 5 years. That works out to $60 billion a year, every year.
Okay, but what's their revenue?
Currently, around $13 billion.
Wait, so they need $60 billion, but only bring in $13 billion. That's a $47 billion hole every single year.
Exactly, a massive deficit. And that money isn't coming from selling things. It has to come from debt, maybe subsidies, or just, well, pure investor faith, hope.
They're burning cash based on future potential, not current reality.
It shows the shift, doesn't it? It's not about building revenue then scaling. It's venture capital logic, but at the scale of a global utility company. And you have to ask, why does this feel even riskier than previous crashes?
I was just thinking that. Remember 2000, the dot-com bubble, lots of hype, retail speculation.
Right.
And 2008, the mortgage crisis, toxic debt, complex instruments. So why label this version 3.0, the AI bubble, and why call it bigger, more expensive, far more dangerous?
I think it's 2 main things, infrastructure debt and that centralization we talked about.
Okay.
The dot-com thing was mostly bad business models and stock hype. This AI gamble is tied to massive physical debt. Those half-trillion-dollar data centers, the power grids, that
Yeah.
requires huge borrowing.
Which makes the fallout systemic, like 2008.
Exactly. It echoes those liquidity risks, but potentially on a much grander scale.
Yeah.
And second, the centralization around Nvidia creates a single point of systemic failure that just didn't exist back in 2000.
And the valuations show investors are just ignoring the risk. We saw that Apollo Global Management finding. Price-to-earnings ratios for the top tech firms are higher now than in the 90s bubble.
Higher, yeah. To put that PE ratio over 27x in perspective for you, it means investors are paying $27 for every $1 of actual profit a company makes right now.
27 years of future earnings priced in today.
Based purely on this expectation of guaranteed exponential growth, back in the 90s, 25x was seen as crazy optimistic. Now it's the baseline. Risk calculus. Out the window.
Okay, here's where it gets really interesting for me. This whole U.S. economic bet isn't just finance. It's completely tangled up with foreign policy, specifically towards China.
Absolutely.
It seems like every tariff, every chip sanction, every government loan, it's all aimed at one thing, holding back China's AI to justify this massive American bet.
And the irony is, while the U.S. uses this kind of brute financial force, China seems to be focusing on strategic efficiency. We shouldn't underestimate their strength.
Like what?
High-quality STEM education, for one. Innovative entrepreneurs. And importantly, a system that lets the government roll out infrastructure quickly and efficiently when it decides to.
And the results show that efficiency gap.
Starkly. While the U.S. is burning trillions, China's been quietly cutting its reliance on the very core of the U.S. CULSA. Bet those Nvidia chips by something like 82%.
82%. How?
By prioritizing development of their own AI systems that are apparently more efficient, cheaper, easier to scale. They're finding ways to run faster at, maybe half the cost.
Wow.
And that efficiency connects to their long-term strategy. It's about a domestic foundation. China isn't just chasing generalized AI models in the abstract.
What are they doing then?
They're integrating AI directly into their existing industrial base, their huge manufacturing sector. That creates this internal loop of supply and demand.
So they need foreign markets less.
Yeah.
Less imported hardware.
Exactly. It makes them more resilient, less dependent on volatile global markets or super expensive imported chips.
Meanwhile, back in the U.S., the sheer cost of this spending spree is creating huge physical strains, right? Affecting everyone, not just tech investors.
Oh, absolutely. The resource demands are striking, especially energy. Just to power all these planned AI data centers, the U.S. needs to basically double its current electricity generation capacity.
Double it.
Aiming for 430 terawatt hours by 2035. Just for AI. To give you some context, 430 TWI is about what a whole country like, say, Spain uses in a year. We're building an entire Spain-sized power grid just for AI.
And the costs get compounded, don't they? It's not just the electricity itself.
Correct. Building the physical stuff, the steel for the data centers, the copper wiring, all the components, those costs are already inflated by 30, maybe 40%.
Wow.
Largely due to the ongoing trade wars and tariffs restricting supply chains. So every dollar you spend buys less actual capacity, which forces you to borrow even more.
Which sounds like the formula for a really precarious debt bomb. You mentioned Meta borrowing $26 billion, Vantage $22 billion for data centers, but aren't companies like Meta hugely profitable? Can't they handle that debt?
It's not just about whether one company can handle its own debt, it's the systemic risk. The sheer scale means these projects likely can't continue without massive debt financing across the board. It's like, print money, increase debt, and hope nobody notices.
So if one big AI project defaults, even one,
given the leverage involved, the scale is so vast it could trigger a credit crisis, like a contagion effect impacting the whole banking system.
a domino effect. Systemic liquidity risk, just like 2008. But instead of dodgy mortgage bonds, the toxic assets are algorithms and hyper-leveraged data centers.
Precisely. And that leads to the final kind of unsettling irony in all this. The economy's structure seems flipped. The stock market now seems to be driving the real economy, not the other way around. The world's largest economy is running on sentiment, not on real production.
So what does this all mean for you, the listener? We've laid out this system built on algorithms, political optimism, and this bet that failure just isn't an option.
Well, when an economy runs purely on sentiment, it means the story, the narrative around AI's future value becomes more important than what factories are actually producing today. It's a bit like a house of cards built on expectations.
And America's reputation? its global standing, future stability. It's all riding on this one super concentrated bet.
Pretty much. And history tends to show that when failure is deliberately taken off the table as a possibility, well, that's usually when failure becomes a total catastrophe if it does happen.
So we've seen the centralized bet, the echoes of past bubbles, China's efficient counterplay. It paints a picture of extreme financial fragility mixed with geopolitical tension.
Indeed. And that combination suggests that, unlike some slow managed decline, economic bubbles tend to burst.
Loudly.
Suddenly, and the sound of this one bursting could be the fall of the world's largest economy, operating on money it doesn't actually have yet. So the question you should probably be mulling over is this. If the whole system needs ever-increasing debt just to fund a future that might not arrive, how close are we to the breaking point? How long can faith substitute for fundamentals?
Think about that concentration risk the next time you hear about another record valuation.